Let's kick off with the selling we've seen in Europe. In your view, what's been the dominant force of the outsized selling we've seen in the banks?
Yeah, I think it's a little bit like the defense sector. I mean, the grossing from some of the players, and also because in this kind of markets, liquidity is king or queen, so you sell the winners. And the banks, they have had the sharpest drop, but if you, up until beginning of last week, they were up 30% in Europe, which is something we haven't seen in many years. So it makes sense to sell what you can when you can.
It's a great point. When you look at the long-term chart, I don't know if we have it here, the Stoxx 600 banking index year to date, that a lot of these stocks, despite the brutal selling that we've had in the last couple of days, are still up on the year. Are there any signs of stress in the banking system? This was something, there was murmurs of it on Friday, some concern, and this would obviously be take things to another level in terms of the uncertainty out there.
Yeah, I mean, so there was this report by the EBA you mentioned, but this is structural. There are some banks, for example, the French banks, they typically short the US dollar, but there is a swap line between the Fed and the ECB and the Bank of England. So I don't think that's never been discussed that the Fed should put this, remove this swap line, because at the end of the day, I mean, the dollar is the financial market of the world, so it helps also the US financial system to have this swap line between the Fed and the major central banks.
So it sounds like degrossing, like we've seen in many sectors, is one of the big reasons for the selling in the banks. What about the prospect for central bank cuts? To what extent is that feeding the selling we're seeing in banks? It feels like the Fed specifically is in a pretty difficult position. If we're looking at a major hit to growth, obviously that raises the stakes for them in terms of cutting rates. But then we're also talking about a potential big inflation impact too.
Yeah, I mean, the Fed is stuck between a rock and a hard place, between the mandate for growth and unemployment, and of course also the inflation, and also because they were wrong the other time around in terms of inflation, saying it was transitory, which it wasn't. And also this is if you look at the European banks, BNP, UBS, Deutsche Bank, there is also a move in the market, and we were expecting a kind of 2% end rate in euro by the end of the year, the ECB repo rate, and now probably going down to 1.5, 1.6. The Deutsche Bank CEO yesterday on the Frankfurter Allgemeine Zeitung was evocating the possibility that maybe Germany could dip into recession. And of course, so this will have an impact on the banks and on the insurance sector.
How drastically things have changed. Now we're hearing the talk that Germany could enter a recession when, 2 weeks ago, it was all about the German trade.
Yeah, exactly. And it's remarkable. At the same time, so Germany is one of the few countries that still retain a bit of fiscal flexibility, which is not the case for many other European countries.